Welcome to this explainer. We are diving straight into the unprecedented financial scale of the AI gold rush, exploring the race to build the world's first trillion-dollar AI company. We're living through what might honestly be the most aggressive and rapid concentration of wealth and computing power in human history. We aren't just talking about a cool new software trend here. We are talking about a fundamental rewiring of the entire global economy.
Just to wrap our heads around the sheer scale of what's happening right now, consider this single, staggering figure, $5 trillion. That's the market cap milestone that infrastructure titans like NVIDIA and Apple have recently shattered. Think about that for a second. We went from celebrating the very first $1 trillion company just a few years ago to watching hardware and silicon giants literally race past the $5 trillion mark in mid-2026.
With company values now rising higher than the GDP of almost every country on Earth, we're talking surpassing entire nations like India, Japan, and the UK. We've got to ask ourselves a monumental question. Who will ultimately control this multi-trillion-dollar ecosystem? Because, guys, this isn't just a technological race anymore. It is a full-blown geopolitical and economic battle for the future infrastructure of the internet itself.
Part 1, the boom, racing to $1 trillion. Let's kick things off by looking at the fierce competition right at the software and startup layer.
While the hardware giants are measuring their wealth in the multi-trillions, AI-native startups are in a brutal, high-stakes sprint to secure their first trillion-dollar valuations. And for early-stage companies, survival and hitting that crucial first million in annual recurring revenue depends heavily on a brand-new playbook. It's called generative engine optimization, or GEO. The old days of relying purely on 10 blue links in traditional search, yeah, those are over. To survive today, these companies absolutely must ensure they are the definitive answer directly provided by AI engines like ChatGPT and Perplexity, because if an AI doesn't cite you as the answer, you're virtually invisible to half of your potential buyers.
And right at the top of the startup food chain, we are seeing intensely divergent strategies play out. It's actually fascinating. On one side, you've got OpenAI. They are projecting an incredible $20 billion in annualized revenue for 2026. But to get there, analysts estimate they could burn through $140 billion in losses between 2024 and 2029. Let that number sink in. Then on the flip side, you have Anthropic. They're currently closing in on a massive $965 billion valuation, but taking a path that analysts believe puts them on a much faster track to actual profitability. It's your classic battle of growth at all costs versus sustainable scaling. Part 2, the build. The $5 trillion titans. Because at the end of the day, all that software relies entirely on physical computing power. Let's look at the bedrock of this entire gold rush, the hardware giants. NVIDIA has completely shattered records to become the world's first $5 trillion company. This mind-blowing growth is being driven by an insatiable, almost ravenous appetite for their AI chips. In fact, their CEO recently disclosed a staggering $500 billion in chip orders. They are the ultimate picks and shovels provider in this gold rush, and their stock performance perfectly reflects an entire industry that is just desperate for computing power. But NVIDIA isn't running completely uncontested here. Alphabet is closing in fast on NVIDIA's crown, recently hitting a $4.8 trillion market cap. Why? Well, they're uniquely positioned because they cover every single link in the AI value chain. We're talking everything from search and YouTube distribution to their massive Google Cloud platform, right down to their own custom silicon. They currently have a massive $61 billion backlog specifically for their in-house TPU chips, making them a seriously formidable alternative to NVIDIA. So this arms race is driving astronomical growth in capital expenditures, what we call CAPEX, among the top 5 hyperscalers like Amazon, Microsoft, Alphabet, and Meta. They went from spending $256 billion in 2024 to an estimated $602 billion in 2026. And the crucial thing you really need to take away here is that 75% of this astronomical $602 billion spend is dedicated entirely to AI infrastructure. We are seeing capital intensity surge to unthinkable levels. Some of these companies are spending nearly 50% of their total revenue just on building data centers. Part 3, the bubble. Boom or bust. With capital intensity surging like that, we absolutely have to step back and ask the big question. Are we building the foundations of a new industrial revolution, or are we just inflating a massive financial bubble? Well, a major source of anxiety for financial analysts right now is the heavy reliance on what are known as circular deals. This happens when a big tech giant invests billions into an AI startup, but with a massive string attached. The startup has to use those funds to buy computing power and chips directly back from that tech giant's cloud service.
You see the issue? Many analysts fear this practice artificially inflates company valuations and revenues, basically creating a closed loop of money that doesn't necessarily reflect real-world consumer demand. And compounding this risk is the sheer volume of private credit and debt being used to finance these long-term data center buildouts. Take OpenAI, for example. They've committed to spending $1.4 trillion over the next 8 years on data center computation. Now, keep in mind, this is happening against current revenues that, while growing fast, are just a tiny fraction of that multi-trillion-dollar commitment. That massive gap, it's being bridged heavily by debt. Because of these staggering debt piles and sky-high valuations, the warning bells are definitely ringing from prominent skeptics and banking institutions. Legendary investor Ray Dalio has publicly warned that this flurry of AI investment echoes the dot-com bubble of the late 90s and 2000s. When skeptics look at this landscape, they see companies failing to secure immediate revenue returns on these massive AI investments, and they see a severe stock market correction looming right on the horizon. But, we are equally hearing from optimists at major financial firms who firmly disagree with that take. Even Federal Reserve Chair Jerome Powell has explicitly stated that AI is fundamentally different from the dot-com bubble and actually represents a major source of real economic growth. The optimists argue that we aren't just building speculative websites like we were in 1999, we are building the physical computing infrastructure that will power productivity and innovation for decades. To them, this is for sure not a fragile bubble, it's a necessary foundational shift. Part 4. The resolution. Who owns AI's wealth? Because regardless of any near-term market corrections, AI is generating vast fortunes. We absolutely have to examine the profound societal impact of this technology. Look at this trajectory. The global AI market is on track to expand from $189 billion in 2023 to a staggering $4.8 trillion by 2033. As this market value just explodes over the next decade, economists are getting deeply concerned about wealth inequality. The real fear is that this unprecedented value is going to be concentrated entirely among a few tech giants, a handful of investors, and within the borders of just 1 or 2 countries. Because the stakes are so incredibly high, we are already seeing governments step completely out of their traditional roles. They're no longer just acting as regulators on the sidelines, they're stepping into the arena as massive investors and direct owners of AI infrastructure. For instance, the UAE's tech investment firm MGX just partnered with BlackRock on a $30 billion AI infrastructure initiative. Similarly, Saudi Arabia's public investment fund is accelerating massive spending to ensure they become a global AI hub. Nation-states are quickly realizing that access to frontier AI models and compute power isn't just business, it's a matter of critical national security. This growing realization has led to a radical but increasingly popular proposal, the creation of AI sovereign wealth funds. Policy think tanks are arguing that governments should actually acquire ownership stakes in AI companies and the physical infrastructure that powers them. The idea here is that instead of relying purely on corporate taxation after the fact, the government acts as a long-term investor. This would ensure that the trillions of dollars generated by AI actually benefit the broader public, maybe funding pensions or public services. It's very much like how Norway successfully used a wealth fund to distribute the economic benefits of its oil boom. It's a truly fascinating shift in how we view technology ownership, right? We've spent decades treating tech as a purely private enterprise, but the sheer unprecedented scale of AI is forcing society to rethink that entire assumption. And this leaves us with one vital, provocative question to ponder as we watch this incredible trillion-dollar race unfold. As AI generates unimaginable wealth and completely reshapes our global economy, who should ultimately own the future?